Welcome to Tony Byrne's View, with news you can use. As a chartered financial planner and wealth manager, Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
How to benefit from an Exempt Property Unit Trust. What is an EPUT? EPUT stands for Exempt Property Unit Trust. It's a special type of unit trust. It qualifies as a diverse investment vehicle. Therefore, it is exempt from paying tax on buying and selling assets or rental income, such as property. An EPUT has major advantages over a small self-administered pension scheme known as a SAS, or a self-invested personal pension scheme known as a SIP when it comes to investing in property. An EPUT may invest in residential or commercial property, unlike a SAS or a SIP, which can only invest in commercial property. Moreover, an EPUT may borrow money on normal commercial terms, typically up to 75% loan to value, whereas a SIP or a SAS can only borrow 50% of the net assets of the scheme, ignoring the value of the property being acquired. A QNUP's EPUT solution to holding commercial and residential property. A QNUPS is a qualifying non-UK pension scheme. The problem with holding property in an EPUT within a SAS or a SIP is that you can only effectively hold commercial property due to the restrictive rules. However, an alternative solution holds the EPUT within a QNUPS, which is a qualifying non-UK pension scheme, which is not subject to HMRC rules as a non-UK pension scheme. As it is not subject to UK pension rules, it can hold commercial or residential property or both simultaneously. Therefore, the QNUPS buys the units in the EPUT. The EPUT holds the properties within its wrapper. The QNUPS EPUT solution when you already own property in a SIP. Let's say you have £1 million of investments in your SIP, including, say, £500,000 in property. 1. The SIP invests its assets into the EPUT in exchange for units of the EPUT. The SIP then sells the units to the QNUPS. The QNUPS buys the units in the EPUT. The value of the QNUPS is thus the value of those units, i.e. the original value of the SIP. The QNUPS buys the EPUT units through a loan from the SIP. The QNUPS then pays the loan at whatever terms are acceptable to the trustees. Once paying the loan back through the QNUPS, the member will be left with a SIP worth £1 million plus interest on the loan, plus any investment growth if invested, and a QNUPS worth the market value of the assets within the EPUT. The reason this solution is valuable to individuals with large SIPs is that it allows them to effectively freeze their lifetime allowance charge, assuming the funds remain in the bank account earning zero interest. It means that the assets can continue to grow in the EPUT without incurring any higher lifetime allowance charge. In the long term, the initial advisory fees and maintenance costs of the QNUPS and EPUT is less than the savings on the lifetime allowance tax charge. Moreover, as the effect of the lifetime allowance charge has been reduced, they can potentially receive higher growth. Therefore, when the lifetime allowance charge is eventually paid, it should be lower because the growth has been transferred to the EPUT instead. You can speed up repayments to the SIP by paying cash into the QNUPS. Do bear in mind that EPUTs are still subject to stamp duty land tax, or SDLT. Unfortunately, you cannot eliminate your tax liability completely. You must still pay SDLT when you make purchases or acquisitions from existing registered pension schemes. Therefore, when you make an acquisition of property by a QNUPS or QROPS, which stands for Qualifying Registered Overseas Pension Schemes, indirectly using the EPUT as a pension asset transfer of land interests, it will trigger a chargeable land transaction at market value for stamp duty land tax. An EPUT is able to borrow more money than a SIP or a SAS. SIPs or SAS are usually limited to borrowing 50% of the net value of their assets. Where VAT is payable, it must be included in the maximum borrowing limit. Despite being later reclaimable, this massively reduces the real value of the loan. EPUT loans do not have the same restrictions. It can borrow an unrestricted amount, subject to terms acceptable to the trustees. This can be of huge benefit to those who may want to borrow to invest in new property, be it commercial or residential. By borrowing, you gear up your investment and can potentially gain a higher return on your investment. Is an EPUT subject to taxes? No income or capital gains tax charges should come about on an EPUT. EPUT is only available to investors who are tax exempt, such as the pension schemes like a SIP or a SAS, because they have these tax exemptions. So an EPUT, or an Exempt Property Unit Trust, has a number of benefits, especially if you own property within your SIP or SAS pension scheme and you have a lifetime allowance tax charge issue or a potential one in the future. Certainly worth considering if you have an appropriate attitude to investment risk and risk tolerance. However, it is a complex area, so it is important to take professional advice. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.